Welcome back to the Daily Crypto Roundup. And today, we've got one of those rare days where everything connects. Macro, regulation, and market structure all hitting at once. And if you understand this episode, you'll understand exactly why crypto is struggling right now, and why it could be setting up for something much bigger. Because while Bitcoin, Ethereum, XRP, and the rest of the market are under pressure, the real story is not inside crypto. It's happening outside of it. And it starts with oil. Oil has surged back above $100 per barrel, and that single move is now rippling across every market in the world. Brent crude pushing past $104 has reignited inflation fears globally, and this is not just a headline number. This is a structural problem. Energy feeds into everything. Transport costs rise. Production costs rise. Food prices rise. And ultimately, inflation expectations start to climb again. And that's exactly what we're seeing now. According to macro analyst Lynn Alden, energy shocks are one of the most persistent drivers of inflation cycles. And she's said before that when energy spikes, it tends to delay disinflation and extend tighter monetary conditions longer than markets expect. That's the key point. Because crypto doesn't trade in isolation. It trades on liquidity. And when inflation fears come back, liquidity expectations get pulled back with them. Now this is where the second major story comes in. The Federal Reserve. The Fed has just held interest rates steady again, keeping them in that 3.5 to 3.75% range. And on the surface, that might sound neutral. But the message underneath is anything but neutral. They are not cutting. They are not easing. And more importantly, they are not confident enough to start doing either. Federal Reserve Chair Jerome Powell has consistently emphasized that the Fed needs greater confidence that inflation is moving sustainably toward target. And right now, with oil surging, that confidence has just taken a hit. Economist Mohamed El-Erian summed this up perfectly when he said, "The Fed is stuck between slowing growth and persistent inflation. And that is the most uncomfortable place for policymakers to be." That's the environment we're entering. Not a recession panic, not a growth boom, but something in between. Slow growth, sticky inflation, what markets call stagflation risk. And this is where crypto starts to feel the pressure. Because over the past year, a huge part of the crypto rally has been built on one expectation: rate cuts. The idea that the Fed would start easing, that liquidity would return, that risk assets would benefit. But now, that timeline is being pushed back. Bitwise CIO Matt Hugin recently said, "Crypto is still highly sensitive to liquidity conditions, and anything that delays easing tends to weigh on prices in the short term." And that's exactly what we're seeing now. Bitcoin struggling to break higher, Ethereum losing momentum, altcoins bleeding, and XRP stuck. Which brings us to the third story, XRP. Because XRP right now is one of the most misunderstood assets in the market. After years of legal battles, the SEC overhang is largely gone. XRP has achieved something most crypto assets haven't: regulatory clarity in a major jurisdiction. And yet, the price is not exploding. Instead, it's grinding sideways, sitting roughly between 140 and 170, unable to break out. And that's not random. That's a shift in narrative. Crypto analyst Benjamin Cowan has pointed out that markets move from narrative to narrative, and once a major catalyst is resolved, price action often stalls until a new driver emerges. For XRP, that catalyst was the lawsuit. Now it's gone. The article frames this perfectly as a slow grind versus breakout scenario. And right now, the market is clearly pricing in the slow grind. Derivatives positioning is muted. There's no aggressive bullish leverage, no urgency from institutions. And that tells you everything. Because if smart money believed a breakout was imminent, you would see it in positioning. But you don't. Instead, what you're seeing is patience. Waiting. Watching. Analyst Messari's Ryan Selkis has said before that utility-driven narratives take longer to price in because they require real adoption, not just speculation. And that's where XRP is right now. If Ripple can drive actual payment flows, expand corridors, and onboard institutions at scale, then yes, you can justify higher valuations. $3, $5, maybe even beyond. But without that, the market isn't going to price it in based on hope alone. So at this point in the episode, you might be thinking, this all sounds bearish. Oil up, inflation risk rising, Fed stuck, crypto under pressure, XRP not breaking out. Where's the upside? And this is where the fourth story changes everything. Because while macro is creating short-term pressure, regulation might be setting up the next major long-term catalyst. A key U.S. Senator, Cynthia Lummis, has just said regarding the crypto market structure bill negotiations, "We think we've got it." Now that might sound like just another political quote, but it's not. Because this bill is arguably the most important piece of crypto legislation in years. This is the bill that defines what is a security, what is a commodity, who regulates crypto, how exchanges operate, how institutions engage with the market. In simple terms, this is the rulebook. And for years, the lack of that rulebook has been one of the biggest barriers to institutional capital entering crypto at scale. BlackRock, Fidelity, major funds, they've entered around the edges, but full allocation? That requires clarity, legal certainty, defined frameworks, and that's exactly what this bill could provide. Former CFTC Chair Chris Giancarlo, often called Crypto Dad, has repeatedly argued that regulatory clarity is the single most important factor for institutional adoption of digital assets. And he's right, because institutions don't operate on hype, they operate on rules. Now, it's important to stay grounded here. This bill is not passed yet. There are still disagreements, particularly around stablecoins, compliance, and banking integration. But the tone has shifted, and tone matters in politics. Because when lawmakers start saying, "We think we've got it," it means negotiations have moved from conflict to compromise. And if this bill does move forward, potentially as soon as the next couple of months, the implications are massive. You're not just talking about price moves, you're talking about structural change. The kind of change that allows pension funds, sovereign wealth funds, and large institutions to allocate with confidence. ARK Invest's Cathie Wood has long argued that institutional participation is still in its early innings, and regulatory clarity could unlock trillions in capital over time. That's the scale we're talking about, and not billions, trillions. So now step back and look at the full picture, because this is where it all connects. On one side, you have short-term pressure, oil surging, inflation fears rising, the Fed delaying rate cuts, liquidity staying tight. And on the other side, you have long-term catalysts, regulation nearing agreement, institutional frameworks forming, adoption infrastructure building. And this is the tension in the market right now. Short-term bearish, long-term bullish. And markets hate that kind of environment because it creates uncertainty. Choppy price action, false starts. Macro analyst Raoul Pal has described this kind of phase as a transition zone, where markets move from one regime to another, and during that transition, volatility tends to increase while direction becomes less clear. That's exactly where crypto is now. So, what should you actually be watching? Because this is where you get your edge. Number 1, oil. If oil stays elevated, inflation pressure stays alive, and that keeps the Fed cautious. Number 2, Fed language. Not just decisions, but tone. Any shift toward easing changes everything. Number 3, regulatory progress. If this bill advances, that becomes a major narrative driver. And number 4, real adoption metrics, especially for assets like XRP. Because narrative alone won't sustain price anymore. And this brings us to the most important takeaway from today's episode. Crypto is not falling because crypto is broken. It's falling because the macro environment is tightening again. But at the same time, the foundation for the next major move is being built. And that's why this market is so difficult right now. Because if you only look at price, you'll think it's weak. But if you look underneath, you'll see something very different. You'll see a market that's being compressed by macro forces, while quietly preparing for structural expansion. And when those two forces eventually align, when liquidity returns and regulation provides clarity, that's when you get the kind of moves people talk about for years. So right now, this is not the breakout phase. This is the setup phase. And the people who understand that are the ones who position correctly before the move happens. That's everything for today's daily crypto roundup. If you're holding Bitcoin, Ethereum, XRP, or any of the major coins, hit follow, stay locked in, and we'll keep breaking this down every single day. And as always, we will see you at the top.